Welcome back to Metal Market News. This is ProFaf, Harry, and today we are diving deep into something that on the surface might look simple, but underneath carries serious implications for the global financial system. And that is the recent statement by Donald Trump about gold, where he clearly said, "You cannot imitate gold. It is real." And while most people focused on what he said as an endorsement of gold's physical uniqueness, I want to take this analysis a step further, because as an independent analyst, what matters more is what was not said. Because silence in markets often speaks louder than statements, and historically, every time gold enters, political conversation, it signals a shift in awareness or pressure within the system. Now, if we compare this moment with historical references, we have to go back to Richard Nixon in 1971, when the gold window was closed effectively, ending the gold standard and transitioning the world into a fiat-based system. And that moment was not just policy. It was a structural turning point, and when you bring that into today's context, what we are seeing is not a return to gold, but a renewed acknowledgement of its importance, which is a very different signal. Now, large analysts in the macro space often argue that when political figures begin referencing hard assets, it reflects underlying stress in the monetary system. And I agree with that perspective, but I would add that in today's environment, the stress is not just monetary, it is systemic, because we are dealing with debt saturation, geopolitical instability, and currency debasement all at the same time. So when Trump emphasizes the authenticity of gold, it aligns with the broader narrative that real assets cannot be replaced by synthetic financial instruments. And this is where my analysis slightly diverges, because while others see this as bullish sentiment alone, I see it as a subtle admission that trust in fiat structures is weakening. And that is a much bigger story, because markets do not move based on words. They move based on confidence. And once confidence begins to shift even slightly, it creates long-term implications that most investors fail to recognize in real time now. As we move forward in this breakdown, the next critical element to analyze is the historical continuity between gold policy and government behavior. Because after the 1971 shift, we saw another important moment under Gerald Ford in 1974, when gold ownership was legalized again for Americans. And while many analysts consider that a minor adjustment, I view it differently, because it represented a controlled reintroduction of gold into public hands without restoring its monetary role, which essentially kept the system dependent on fiat, while allowing individuals in this ancient to hedge against it. And this dual structure still exists today, where governments operate on fiat but quietly accumulate gold reserves. And that contradiction is something major analysts like to highlight as evidence of long-term distrust in paper currencies. And I agree with that, but I would push the Decoy analysis further by saying that this is not just about distrust, it is about strategic positioning, because central banks are not accumulating gold for decoration, they are preparing for potential systemic shifts. And that is why Trump's continued references to gold matter more than they appear, because they bring public attention to something that has largely been operating in the background. Now, when we connect this to current market conditions, we see that the dollar remains strong relative to other currencies. But that strength is largely comparative, not absolute. And this is a key distinction, because a strong dollar does not mean a stable dollar. Simply means other currencies are weaker. And this dynamic often suppresses gold prices in the short term, which creates the illusion that gold is underperforming. But in reality, it is maintaining its purchasing power over time. And this is where I align with traditional gold analysts, but also challenge the narrative, because focusing solely on price misses the bigger. Finally, when we bring all of these elements together, the most important takeaway is not about whether gold will go up or down in the short term, but about what its increasing presence in political and financial discussions signals for the future. Because when leaders like Trump repeatedly reference gold, even in a symbolic context, it indicates a growing awareness of its role within the broader system. And when analysts call for audits, transparency, and accountability, it reflects a deeper concern about the integrity of that system. And from my independent standpoint, I believe we are entering a Phase where these discussions will become more frequent and more significant because the underlying pressures that drive them are not going away. They are intensifying, and this is where I slightly diverge from mainstream bullish narratives because while I do see long-term strength in gold, I also see increased volatility along the way, driven by policy shifts, currency fluctuations, and geopolitical events. And this means investors need to approach the market with both conviction and caution, understanding that gold's value is not defined by daily price movements, but by its role within a changing financial landscape. And ultimately, the question is not whether gold matters, but how much it will matter in the years ahead, and whether current systems can maintain confidence without addressing the structural issues that continue to build beneath the surface. And that is the real conversation that needs to happen, because once confidence becomes dependent on perception rather than transparency, the foundation of the system becomes increasingly fragile. And that is something every serious investor should be paying attention to. This is profound. Harry and you are watching Metal Market News, where we go beyond the headlines and break down what truly matters in the world of precious metals.